a management joining in as well, so I'd request you to listen into this. Home First Finance, it saw healthy business momentum in Q2 because of customer acquisitions being strong. Further, the company has seen margins expand, but interest expenses have also seen a sharp 17% sequential rise. Manoj Viswanathan, who's the MD and CEO of Home First Finance Company, joins us now to talk about that. Manoj, good morning and greetings of the season to you and your team at Home First. Can you start a little bit by telling us about the customer acquisition itself? What is the outlook going forward, and how do you see the trend as far as the loan growth is concerned for the rest of the fiscal?
Customer acquisition is strong because demand for housing is fairly strong. Post-COVID, that momentum continues. The demand for housing. So our distribution is also expanding to kind of capture this momentum that is there in the market. So that is what it is.
You want to give us a loan growth target for the year, Manoj?
Target for the year, we are on track for a 30% growth.
Okay.
You can see, the quarter-on-quarter is also at about 7.5%.
Okay.
So on an annualized basis, 30%.
Okay, got that. All right, so 30% growth is what we're working with. One worry, so to call it, is your interest expenditure was higher than the interest income. So clearly the cost of borrowing has gone up. My question to you is, how much of this higher cost has been passed on? Point number one. And in turn, what would it mean for NIMs going ahead? Because the risk is to the downside. Go ahead.
That's right. We are passing on the cost increase as it is getting transmitted to us. So you can see that on a quarter-on-quarter basis, the spread is constant. So we had a spread of 5.8% last quarter, and we have maintained that spread of 5.8%. So we have so far transmitted about 25 basis points to customers, and that is the transmission that has taken place to us as well. So we have a completely floating rate book, so we should be able to pass on the increase to customers as it happens.
Manoj, what is the incremental loan yield for the quarter?
On new originations, we are clocking about 13.4%.
So you're a relatively smaller player, and the big bet that investors are taking is that you'll be able to continue to grow at 30-40% for many years to come without too much issue. But if interest rates continue to rise like this, how much more rate hikes can consumers take, and will there be demand at those levels? Will you have to go down the curve to get to that, as you just said, 30% loan growth target?
Right. I mean, if you see the affordable housing segment, I mean, the segment that we are operating in, it's a very large spectrum of interest rates where companies operate across that spectrum. So you have companies starting from say 10%, 11%, all the way up to 18 to 20%. So there are customers right across the spectrum. So we are fairly confident that 50 to 100 basis points of price changes will not impact the demand. And customers generally calibrate their own demand for the loan or their loan ticket size based on the interest rate. So a 1% change in interest rate would mean probably they have to borrow slightly lesser, but that would not really change their decision to purchase the house.
Okay, in fact, that's what real estate realty guys also tell us. Of course, it's in their own interest, but they do tell us that when interest rates move, it doesn't really impact the buying decision of the home buyer. But I wanted to understand a little more about your margins. They expanded this time, but your interest expenses have also grown. So tell us, what is the ballpark margin that you can end the year with, the net interest margins?
We are passing on the rate increase to customers. So we are confident of maintaining the NIMs.
At around 6.5%?
That's right.
Okay, all right.
Okay.
Manoj, before we let you go, final question on asset quality. It's improved a little bit. Your net NPAs are at around 1.4%. Gross NPAs have come to around 1.9%. So what's the outlook on this front? And you joined us, I think a month or so ago, because there was the fear that Warburg, that has a large holding, close to 28%, the fear was that they will sell. You said at that point of time you haven't heard from them, and you believe that they're not looking to sell. Any other dialogue you've had with them, or you've not heard from them till now, and they will hold on to that big chunk?
No, absolutely. I think that was just a rumor, and there is no such plan to exit the company at all. So that is, I think last time also we went out and mentioned that. So that stays. I mean, that stand stays. They are here for the long haul.
Okay. Asset quality?
On the asset quality, things are, if you look at the collection efficiencies and, customer behavior, it's back to pre-COVID levels. There are a few customers who got impacted by COVID and because of the new RBI norms where we have to report them as NPA, small cluster of customers are still being classified as NPA. Otherwise, things are really back to normal.
Okay, all the best. Things are back to normal. I guess that's the moot point, right? Thanks a lot for joining in and giving us a view on the business. That's Home First Finance. Let's slip into a quick break. Up next, we will have our technical experts joining in. Mitesh Thakkar and Kush Bora will be with us to talk about some technical trades and how to plan the day.